Can you guys hear me loud and clear or not? Just wonder. Should be fine, I guess. At least from my side, I can hear it very clearly. Okay. Good evening, everyone. Hope you guys have a very good weekend last week. And then recently, the market is very volatile. It's like rising up and dropping sharply in just a very short period of time. I hope you guys make some profit from it. And I hope your wallet and your account didn't get hurt due to the US elections and just make some money instead. But you guys also need to be careful for the drop in the option price, as usually there will be a volatility crash in the IV value after the news land. If you keep on following the class and listen to the content, you will know that in the last week classes, and then we had talked about the grid value, which is the Vega. And it present that if the volatility increase, the option value will increase and vice versa. And that's why currently the option value is so high. When you buy the options, the premium is insanely high. The IV for all those stocks are very high. So when the news land, the uncertainty in the market is gone because we already have the result on who is winning on the elections. So when the uncertainty is gone, the IV will also reduce. So the option value will drop also. So no matter it's a call options or put option, usually it will be just double Q. Usually it will just double Q in both options. So it's just a little bit on what we are going to talk for today. And last week class, we talked about Vega, and this is also what we are going to make use of it and then apply to the market condition now, which is very good practice if we make use of what we study and then we put it into the market conditions. So let's get back on today's classes. My name is Junlo, and you can call me Jay, or you can call me 小何老师 instead. It's up to you, whatever you want. And still in this class, we are not going to sell you some other classes. I'm not going to upsell you, and then I'm not going to collect any personal information or money from you. So be aware if someone come and approach you to get some informations, your email, your phone numbers, or your money. That might be someone, but it's not me. So just be careful. This is 100% free class, and then I hope you can enjoy it and we can become a financial expert and make some great money together. Today, we will be talking on how do we use the advanced options strategy for different market so that we can counter for different market scenario. There will be market like the current market situations, which is very high volatile due to the news, or we can say the US election for now. And there will be also the case where the market is ranging in for a longer period of time without any specific move. So we will need to know that what will be the strategy to counter for different market scenario. But first of all, we will just go through a little bit of recap on the basics of the option so that we won't get lost in the middle. So let's start on today's classes. So into today's class, we will actually cover the advanced option strategy. And the advanced option strategy is actually just a combination of two options, which is the call options and also the put options. They are the basic to just make the whole strategy work. So it's just a matter of how do we combine it with the different strike price and also how many options that we are going to use to make our strategy. Like maybe you can use two call options or two put options, or you can just use the call and put together to make a strategy. So it's just a quantities and also the strike price difference. So to make everything work. And when we are going to talk about difference market, what I mean is the market can usually be in a downtrend or in a ranging zone, or also an uptrend. But actually, we can just categorize it into two categories, which is a high volatility market and also a low volatility market, which the low volatility market will actually bring us a very ranging market. And also when there is a volume in the market, it will actually have some very clear direction. Either it will be trending or it will be reversing, but there will be very obvious signals to just show that is in what condition, in what scenario the market is currently falling on. So in today's agenda, we will just go through a little bit fast because there is a lot of things to cover for today's class. So whoever that might not be able to catch up, remember to just pick it up, and then we will just slow down a bit. Maybe we can just control the pace to a very suitable speed to make sure that everyone can follow. Okay, so in today's agenda, we will actually cover the review of the basics, which is the theory of the call options and the put option, because we will make use of it, and then we can combine and make some advanced strategy. So for whoever that doesn't know about the basic options, you can actually approach me to get the recording, the video recorded for the previous class, and I will leave my contact at the end of the webinar so that you can actually contact me to get it. Else, you can just check on the Smart Hong Kong apps, and in the live streaming sessions, there will be actually the video recorded will be placed there. So two-way for you. Or you can just wait for until the cycle is in, then we will just go back to the beginning, which is we will just talk from the beginning on the basics of options, and then slowly we will move it to the advanced series. So there will be a cycle, but I'm not sure whether the cycle will be restart on every month or longer. It's still in a still need to decide later. So, okay, let's get back to the topic. So after we get to review of the basic, we will talk on how do we combine those options to make a strategy for the high volatility market, highly volatile market, and also the strategy to counter for a ranging market. And we will talk on how to combine those and what is the reason of doing so. After that, we will have some other class to go into the detail and some case study. But due to the time constraint, we might not be able to go to a real cases in today's class. So we'll just cover on the theory behind first to make sure that all of us know that why are we going to use this option? What is the theory behind this supporting us? So afterwards, we will have some other classes, advanced classes, that will go into the details into all of these advanced strategy, and then we will just go through the market together to fill up some, and maybe we have some live trading session afterward. We will arrange it, okay? So let me give you some review of the basic first. So when you are buying a call options, you are the buyer are actually paying the premium. And actually you are betting that the future price will go above the strike price that you set. So I have put on the chart for your illustration purposes where the dotted line will be the strike price that you set, and the area above will be your profit zone. So wherever then the future price go above the strike price that you set, you are actually in the profit zone. So you're actually hoping that there will be a breakout above the strike price you bought. But before that, you're paying a premium upfront. So what happens if you are the seller? Simple. It will be just a reverse of the buyer cases. You will receive the premium upfront where the zone are in the where the zone where the buyer are in profit, you'll be a losing zone. And then, but you are able to get the premium upfront. So there will be pros and cons for each cases, but we will just make use of it to just make some advanced strategy together. So if you are wondering about the theory behind, you can just check on the basic options series, and then we have some classes that talk on the explanation and elaboration of the call options and also the put options. But right now, we will just move on very quickly together. So we just bear in mind that above the strike price is the profit zone for buyer, but will be the losing zone for the seller. So let's move on to the put options. Actually, the put option is just a reverse cases, whereby the call options is aiming for a bullish market, but the put options is actually looking for a bearish market. So they are counter for different market. The call are for the uptrend market, and the put is for a downtrend market. But in the same conditions, where the buyer need to pay the premium upfront, and the seller are going to get the premium upfront. So the benefit of being a seller is actually collecting the premium upfront. So no matter what is the result, you can keep the premium. It's just a matter that the premium collected able to cover the losses or not. If there's no losses, the premium actually go into your pocket, and then you are securing the gain upfront. So we also have a classes that talk on the benefit of being a seller party in options. And now we will talk about the grids, which we already covered in the last class. Total, there will be 4 of them. Actually, there are 5, but one of them I think is not really important because the interest rate doesn't float that much. So we can just ignore it. So for the delta, it's actually reacting based on the share price. When the share price increase, it will make the option price to increase. And for the gamma, actually is also based on the share price, reacted based on the share price. But the end result is not the option price, but the delta. So one will be the speed to the option price in growth, and then one will be the accelerations, which we already talked about it in the last classes, and you can go through it again and again, which we already recorded in video. And then the next one is theta. Theta is known for being on the opposite side to the buyer. When you are the buyer, you are actually fighting the theta. And it is because the theta reduce the option value across time. When the remaining time reduce, the time decay will actually become greater. And I have put in some chart for illustration afterwards, just a few slides later on, and we will go through it together. And then the last one is Vega. Vega is when the implied volatility increase, it will make the option price to increase. So for current conditions, which is become the most important factor for current situation, because due to the news and the US elections, the volatility in the market is actually very high now. So the option price is also at a very sky high level. So if you get in now, you might get hurt for the drop in the volatility. So for theta, it also can in the market, there's a say that theta is actually the can represent the winning rate of the options when it fall on the expiration dates. So in the chart, you can see that the dotted line is the market current prices. So if you are buying the options with the strike price below the market current price, which for example, the market current price for Apple is selling at 100 now. So if you are buying options that secure you to buy at the future with a price of 50, which is far lower than the market current condition, you actually have a greater winning rate compared to when you are buying at a higher strike price. So when you are buying an options with a with the lowest strike price comparing to the current market strike price, current market price, you actually have a higher winning rate, which make the delta higher. And the vice versa, when you are buying a strike price that fall above the market current price, the winning rate is actually lower because you are betting that the price will go above the price that you are expecting. So this is for the case of call options, which is easier for our understanding. So we already talked about delta. Delta is actually the velocity to the growth of the option price, which make the options able to leverage the gain. So, but in the case of gamma, gamma is actually the accelerator to the speed because we already talked about it. Gamma will increase the delta value. So for every dollar changes in the share price, the delta is actually increasing. So when the delta is increasing, the growth in the share price will also increasing in an exponential way. Then here comes the theta. The theta is actually make the option value decay as the time pass. And then you can see on the chart, when we are buying an option with a strike price within a month, and you can see that the time value is the green line is actually decaying. So when it comes to the expiration dates, the option doesn't have any time value left. It only has the intrinsic value. But what happens if you buy options with a longer expiration date? This will be the case. I will leave the green line for your comparison. So if I'm going to buy options with 3 months left, with 3 month expiration, which represent by the blue line, you can see that the graph actually look like this when it comparing to the 1 month expiration options. And you can see that for the first month, the decaying speed for the blue line, which represent the option with a longer expiration date, is actually decaying much more slower comparing to those who are going to expire soon. But it applies the same that when it comes to the last 30 days, you can see that the time decay is actually accelerating. So if you are going to be a buyer to the options, the call options, I will suggest you to buy an option with a longer expiration date so that the time decay doesn't reduce your profit that much, so that you can make sure that the profit from your options is able to just way past the time decay, and you can just I will also suggest you to close the option positions before the acceleration happen. So I would suggest you to buy a longer option with longer expiration date, like for example 1 year, and then you can just close it before 1 to 2 months until the expirations. And the last grid value that we cover in the last class is the vega, which the implied volatility increase will make the option price to increase. And they are in a directly proportional relationship. So how do you make use of the implied volatility? Actually, you can buy the options when the volatility is low, so that you are actually buying at a lower price. And then when the implied volatility increase, you can sell high. As simple as that. Buy when the volatility is low. When the market is ranging, and then you can just buy it. But when the share price is going to spike up and then events happen, and then there is the drive in the volatility, and the market is in a very, very unstable stage, you can just sell it directly and then make a very huge profit out of it. So for now, the market condition now is actually fall on the high volatility side. So be careful if there's a drop in the future. So you need to protect your options. So to just summarize on the basic, I will just say that there will be a call options and also the put options, and whereby we can become a long party, which is the buyer side, and also the short party, which is the seller side. For the buyer side, we have to pay the premium upfront, and then we enjoy the profit after it exceeded the share price that we set. For the seller side, it's vice versa. We have unlimited losses, but we're able to collect the premium upfront. As simple as that. And then we will just use this concept, the combination of these four, to make our advanced strategy. So how do we combine those to counter for different market? As we have said, there will be three types of market, which is very easy to identify based on the chart. Either it's in a downtrend, ranging, or uptrend. For now, the US market is in a crazy uptrend. There's no top for it. But we also can categorize it into the low volatility and high volatility. No matter it's in a downtrend or uptrend, the strategy we apply will be the same. It's just that we will be focusing on using the call or we are going to use the put instead. So actually the strategy to counter for downtrend and uptrend will be the same. Now we are going to the strategy part, but we will have what will be the characteristic of the ranging market first, so that we can counter it one by one. First one, when we talk about the ranging market, we can tell that the price action is actually in a sideways condition. Okay. Very defined support and resistance range, and then the price is trapped in the range. And then we can check out the volatility. The ranging market are often marked by a lower volatility with a minimal direction movement, so that the volume is actually lower. The trading volume is far lower when comparing to a directional market. And it is predictable because there is a very clear support and resistance you are able to find on the chart directly. The ranging is on falling in this zone, and then you can just buy low and sell high until one of the day it breaks through some certain level. But there will be also some challenges, which is the false breakout. The ranging can be prone to be sudden and then have a very short life breakout, and then it will lead you to potential losses, and it trick you like it's going to change into a directional manner, but it actually a trap for you to just get back into the range instead. Many people will lose money to trying to catch the breakout, trying to catch the moment that a ranging market become a trending market. Actually, we can just wait until a trending market signal is confirmed. Maybe just a break and retest will be better. So there will be a confirmation of the changing in direction instead of catching on the breakout strategy. And the ranging market also lead to a limited profit potential, because you can tell that even though you buy low, you can tell that there's a very obvious resistance up there. So the profit that you can gain is just that minimal range. Unlike the current market, which is always in the uptrend and there will be no top. So once you get in, you can just move your stop accordingly and then to catch the whole movement. Because ranging, the narrow price movement will limit your potential gain. So it requires a very high frequency entry and exit. You can just try on every low on the support to buy in and then try on to every sell on the resistance. But higher transaction cost will require because the trading frequency is increased. So you will need a higher cost to capture all those small gains. Now we know the characteristic of a ranging market. It's actually represented in the chart like this, where you can tell a very obvious support and you can tell a very obvious resistance. And how do we counter it? How do we counter this kind of market? Very simple. We use a credit call spread and a credit put spread. So we will just move into what is a credit call spread. And then after that, there will be an iron condor and also a butterfly strategy. These four strategies will be suggested to counter for a ranging market. Now we will talk about how do we create a credit call spread. First of all, we make a sell call. Okay, from the chart itself, you can see that once we already make a sell call on the resistance, above the resistance, we receive the premium. The premium received will be our profit. But we will need to be careful if there's a breakout happen and lead to unlimited losses. So we will make a buy call above to limit our losses, so that when we buy a call options above, the unrealized P&L is actually offset. So it will limit our losses to only the zone in between. And then usually the premium that you get from a sell call will be much more higher than the premium you use by a call. So you get to earn the difference in between the premium and you limit your losses. For the case of the credit put spread, it's actually just a reverse of it. When we are talking about the credit call spread, we are actually make use of the call options. Now we're going to make use of the put options. We make a put, we sell a put first. Remember, when we are talking about the strategy to counter for a ranging market, the focus is always in selling. We are targeting to earn the premium and then use the buying side to just cover the losses, to just limit our losses. So the focus is make profit from the premium. The call side, the buy side is actually, the long side is actually just to limit the losses. So now we make a sell put and we receive the premium upfront. To just limit the risk, to just limit the unlimited potential losses, we make a buy put. So we now the area that duplicate will be offset. And then this is the same case whereby the premium that we earn from the selling is actually greater than the premium that we pay to cover to limit our risk. So in these cases, you can see that both methods are actually making a profit from the difference in the premium. When you combine the credit call spread and also the credit put spread, because they are only for one direction, when you combine both, this is actually called the iron condor strategy. So easy, simple. When you are using only one side, when you are only using the call side, you are actually doing a credit call spread. When you are only using the put side, which is you are doing a credit put spread. But when you are combining both, you are actually making an iron condor. Now we already covered the third strategy, which is the iron condor. And here comes the most difficult strategy, which is I found it to be the most difficult strategy to counter for ranging market, which is the butterfly. First of all, you will need to sell two call options. Comparing to the previous example, for every one of them is just using one options, one call options, one put option. You're buying one only. But in this case, you are selling two call options. So when you are selling two call options, the premium is actually double. So when the premium is double, you will need to limit your losses by buying one call options. Actually, you need to buy two, but just at the different prices. So when you are buying one below it, you are actually making a profit just above the buy call strike price. So now you're paying a premium and then you need to buy another one above it. This is how this strategy works. So the area that duplicate up there will be offset. And you can see that in these cases, the premium that you earn from selling is actually double. And usually it will be around the same to the premium that you pay for buying an options. So in this case, the cost might be a very minimal stage, but the price still remain in this zone until the expiration date. You are able to use the minimum costs to cash the great profit if it fall on the zone until the expirations. It's a very difficult cases. So maybe we'll just have some deep class further on to just showcase in the real time example. So now we are talk about the volatile market. When we talk about a volatile market, the first one is it usually have a very frequent price swing. The high volatility will large up and then you will large up and down the price movement. And then it will increase the options premium because we already talked about the relationship between the volatility and also the option premium. So a higher volatility will often raise the options premium, which will benefit the seller because the seller is the party who gain the premium. Then is the quickly changing trend. The price trend can reverse rapidly, and then it's challenging the traditional analysis methods. So you need to able to catch all those moves, either it's down or reversing. And the rapid price movement will increase the potential for a large gain, but the losses will also be higher if you didn't do the risk management properly. And it requires a very complex strategy, which in the ranging market, if you only know how to buy low and sell high, that will do to make you a profit. But in order to profit from a very volatile market, you need to able to identify the trend, to catch on the trend, and also able to find the signal of reversal to just close your positions and also into the counter trend, get into the counter trend. The last one is the psychological pressure. The intense price swing can lead to a very emotional decisions making. So it challenges the traders and also the investor disciplines. Now we know that the difference between the ranging market and also very volatile market. And we will talk on the strategy to counter for volatile market. And this is how a volatile market presents. You can identify the changes in trend, and also you can identify the change the trend very obviously. There will be higher high, higher low, and also there's a break of structure for reversal, which we will be cover all the technical analysis soon, I guess. So for the strategy to counter a volatile market, the first one will be the straddles. And the second is strangles. And then we will have a debit call spread and also a debit put spread. For the ranging market, we are using the credit call spread and also the credit put spread. So do not mistaken about it. And this strategy are actually very easy to just catch the movement for a very volatile market. So in the previous years, I used this strategy for the cryptocurrency market, which it is very easy to profit from Bitcoin and also the other coin because the cryptocurrency is insane. The movement is insane when comparing to the traditional market. So I found this strategy very useful, which the straddle is actually my my favorite strategy to be used to catch the cryptocurrency profit. Okay, now we talk about the straddles. What is a straddle? The straddles is actually you are buying a call options at the money. When we are talking about at the money, which means we are buying it the same strike price with the same market price. So you can see from the chart, we are buying at this level, which is where the current market price fall on. So we pay a premium and then we make sure that if the future price is higher than the current price, we are going to make a profit. And then we going to buy another put options at the money. So we also make sure that no matter the market is in an uptrend or a downtrend, we are able to profit from both directions. It's just a matter that the profit able to cover the premium that we pay or not. So for the market like the cryptocurrency, you can see that in half years, it can rise from 20,000 to like now it's like 75,000. So it's very hard for the cryptocurrency to just maintain at certain levels. So I found this strategy to be my most favorite strategy to be used to counter for the cryptocurrency market. My favorite strategy all time. When you know that the underlying assets are very highly volatile and cannot just trap on a certain level within that period of time. So this is straddle. When we are talking about straddle, it's just that we are buying the call option out the money and we are buying the put options out the money. When we are talking about out the money, the difference is just that we are not expecting the price, we are not buying with the same strike price as the current market price, but we are expecting it to move a little bit more upward or downward. The strike price for a call options will be set a little bit higher compared to the current market price, and the strike price that we buy for put options will be a little bit lower. So in this case, you will find that the options premium that you pay is actually lesser comparing to the straddles because there's a distance. So the zone that you are unable to profit is increased. So the premium that you pay is also lesser when you compare to the straddle. So after we talk about the straddle and the strangle, now we talk about the debit call spread. The debit call spread, you are actually buying first and then you do the selling afterwards. So when you compare to the credit call spread, it's actually focusing on selling first. So selling to get the premium and then to buy the options to limit the risks, to cover the risks. So in this case, we do it vice versa. We buy first to catch the trend. So we buy a call options. We pay a premium upfront and then we just do it normally. We're expecting the future price to fall on the green zone, which is higher than our strike price. And then why we are going to use a debit call spread? because the premium is actually very high in some cases for some specific asset. So we want to able to make sure that we can use our limited capital to get access to multiple assets at one time. We need to lower down the premium that we pay. How do we lower down the premium that we pay? We actually do another opposite position, which is the selling call options to get the premium. So in this case, we sell a call options. We get the premium, and the premium usually will be lesser than the premium that we pay, but it able to cover part of it. So in this case, although we limit our risk to just the difference in between, we limit the cap of our potential profit, but we are able to use a lesser money to get into this position. So if you don't have enough buying power to buy a call options, this is how you do. You can just do another opposite positions to get a premium to cover part of it. So a debit call spread is for catching an upward movement. So in the opposite way, when you are going to catch a bullish trend, you are actually using a debit put spread, which also the same underlying theory, we buy first. When we want to catch the trend, we buy first. So we buy one put options. When we buy one put options, we make sure that we are going to profit from the downfall. Put options for the downfall. Okay. Then we sell another put positions to get the options premium to cover the cost that we pay upfront. So now, although we limit our potential profit, but we are able to lower down the premium that we're going to pay just to make this strategy work. Usually, I found this strategy very useful because we want to lower down the cost for every entry. So even though the profit will also be limited, but in this case, we get to have more chance for our trading error and mistake. And then we are able to have more misjudgment on the trend directions. It increases the frequency that we are going to try. So we'll just summarize on the strategy to be used for a ranging market and also the strategy to be used for a volatile market. For the ranging market, we use the credit call spread and also the credit put spread. So we get the premium and we use the another position to limit the risks, to limit our losses. Whereby when you combine both, it become an iron condor. An iron condor, I find very useful when we are going to apply on some very stable index ETF. So because those ETF are actually having a very low volatility when comparing to individual stock, like Tesla and Nvidia is going crazy. Like the Volatility is also have a very high crazy upward movement. But when you come to comparing to SPY and QQQ and also the gold, usually the movement are not that crazy and the volatility is actually lower, so that you can apply the iron condor to just make sure that the price fall within the range that you expected it to be fall on. And then the last one is also the butterfly, which is using the minimal cost to ensure a highest potential profit. It is very difficult to explain now, so a real life example, a case study might be better. And then for volatile market, we are actually using the straddle. We buy a call options and we buy a put options. So no matter what direction that the underlying asset is going to head off, you profit from both ways. It's just that you need to make sure that the movement the profit that you make from the movement are able to cover all the losses that you pay, all the premium that you pay upfront. Then here come the strangers. And strangers is actually the same as the straddle, it just with a lower cost. And the last one is the debit call spread and also the debit put spread. It's actually the same with a buying a call option and put options. So, but comparing to the traditional buying and call option and put option, which expecting the price to have a crazy return on it, you can just using another opposite position to lower down the premium that you pay. You do a short position first so that you are able to use the premium earn to cover the premium pay. So this is the options strategy to counter for different market situation. So if you do remember that we talk about grids, the delta, gamma, theta, and also the vega, actually you can use all those into this strategy to make your winning rate higher. For example, the iron condo, you can actually just move your positions higher so that you can see the delta is actually lower. When the delta is lower, it means that the winning rate for the buyer side is lower. So you as a seller, because in the ranger market, you are a seller first, and then you use the call buyer position to just limit your risk. So you are actually a seller. You are focusing on seller. So you can just check on the delta value to increase your winning rate. So it's a vice versa for the volatile market. You can just make sure that your buying position have a higher delta, and when you compare to the other assets, the other options. So you can use the grids to select the most favorable options when you compare to among the others. So here come the ends of the sharing sessions. And I found this book very interesting, which is written by James Cody, and then it's a complete guide to option selling. And it talk about very advanced strategy on selling and also how to counter for a ranging market. So if any one of you is interested, you may get to read a little bit of it. And then if you are a book lover, so here come the end of our sessions. And hereby I will share my contact. You can just contact me on VCom and scan it using WeChat, or also you can contact me with WhatsApp. So if you have any questions or there's any desired topic that you want to discuss about, you can just contact me so that I can arrange it into the schedule and then we can just talk about it together. If you do realize in today's case, I didn't include any calculations and also any real life example because I think that the theory in itself is actually very difficult. So I use the chart for illustration purposes first. And then in the future, we will go through all those advanced option strategy one by one. So in the current market, which the volatility is insane, you can consider to get into the market with the suitable option strategy. But do be careful because now the president is already decided. So uncertainty is gone. But no matter who get to win the elections, I believe that the US market will be in a very will benefit the US market. A stable politics situation is always better for the financial market. It's just that I think that if in this case, Trump win the case, so those big companies will have an immediate benefit from all those policy, and it might have a rapid rise when you're comparing to the other parties. but eventually it will lead to a inflations to the market, and then it might be a changing in direction. Not now, but later on. And at last, I'm going to show you the benefit of being a USmart user. So if you're going to be registered for a USmart account, you get to enjoy the Tesla share. And then if you deposit more, you can actually get higher value in the cash voucher. And here is the QR for your registration purposes. So if you are interested to get into trading, no matter it's a share, options, CFD, you can feel free to register. If there's any question from your side, you can just let me know. The theory part are mostly get covered, so we might slowly move into the practical part, which I will just show you how to my method of reading the chart, and also how do I time my entry and exit, and then how do I select on the options among all the others. We will get into it bit by bit, and there's two ways of doing it. Either the chart pattern, the reading the chart style, or we can use the fundamental style, which we are going to buy an option with a longer expiration date, but we will need to study the fundamental of the company first. So we get to read tons of financial reports, and then we select the diamonds share among it, and then we will just buy the call options with a longer expiration date, so that we can wait for another financial report to release, to wait for the company to grow, and wait for the fundamental to reflect on the chart, to reflect on the price. But it takes time. Different method will lead to different strategy. It all depends on your preference. If you like to trade in a higher frequency, you can actually be using the technical analysis style. You read the chart first, you select the stock that you are looking for, and then you use the grid value to filter out the most suitable options going to choose. Then you only get into the trade. So if there's no more question from your side, we are going to end this section earlier. And then at last, I'm going to show you the disclaimer to just avoid any misleading information. Let me see. It seems like there is questions from one of the party. How long we need the date for straddle? It depends. Because you are actually expecting the price to escape from the zone. So how long are you going to willing to wait for the price to react? The longer the date you're going to choose, the risk will be slower. Personally, I would prefer the options with a longer expiration date when it comes to buying. Need to choose the same dates for both. basically, if you are doing the normal way, you need to choose the same date, so you avoid any mistaken concept. But if you are advanced player, you can actually benefit from the difference in between. Let's say that let me show you the cases whereby the let's see when I'm sharing let me move to the time value part to just show you how do we use strategy for here is it. So you can see from it, it's actually when when you buy options with a longer expiration date, the blue line, the time decay is actually slower. So when you are selling, the time decay is actually faster. So there is a strategy that we are going to sell for the green line and then we buy for a blue line. So you can just, but you need to be careful on the premium you pay. It's a very difficult strategy because you need to consider multiple factors. Now the time is different, the strike price is different, the premium that you pay is different. So maybe the strike price is the same, but the more variety is more difficult for you to handle. So in this case, even though oh sorry, I mistaken it. So you are talking about straddle. You actually you can choose the same date. I would say I would prefer it to be the same date. The case that I shared just now is actually for the credit call spread and also the debit call spread, where we need to have a buyer position and also a seller position. But for the straddle, it's actually just two buyer positions, so it will be more preferable if you're choosing the same date. Sorry that I mistaken your question. It's a bit confusing after a long sessions of class lecturing. Okay, it's good to have you guys here. So if there's no more questions, then we were going to end these sessions now, and then we will just see you guys on next classes. Okay. Okay. Then thanks for you guys, and then enjoy the market movement to welcome for the Trump. Okay, see you again next. Thank you.